Hello and welcome to part 15 on the subject basics of accounting. Now, till the last session, we have gone through almost the entire process of accounting, and we are left with something which is final, and that is final accounts. Now, in this particular session, we are going to cover very important aspects, and those are final accounts of businesses, which encompasses trading and profit and loss account and balance sheet. So as you see in this particular session, we are going to cover only the theory part, and the next session we will be solving the problems as far as final accounts are concerned. Now, what are the topics that we are going to cover in this particular session? We have introduction, then we have trading account, profit and loss account, and we have the balance sheet. Let's get into the introduction of final accounts. Now, before I get into the concept of final accounts, we have to understand why is the name of the account final accounts. It is prepared finally, that is at the end of the accounting process. Usually these accounts are prepared at the end of the accounting period. An accounting period, as we have learned, it is usually a year. Since this is accounts prepared at the end of the year, this are called as final accounts. Now, final accounts of a business will depend on whether we are talking about a trading business or a manufacturing business. So when we look at final accounts, depends whether we are talking about a trading concern or whether we are talking about a manufacturing concern. Now, if we are talking about a trading concern, three things makes up for the final accounts of a trading concern. We have trading account, profit and loss account, and balance sheet. Suppose if you are talking about a manufacturing concern, in that case, four things makes up for the final accounts. The first one is manufacturing account, second is trading, third is profit and loss account, and the fourth one is balance sheet. So if you look at trading and manufacturing concern, we find one extra account that we prepare, and that is called as manufacturing account. Now, let's understand the concept of trading account. So first, I'm going to take you all through the statement form of understanding this particular concept, then how a trading account looks like. So what is the objective of preparing trading account? It is prepared to find the trading result of the business. So as we understand trading, buying and selling of goods. So basically, trading account is prepared to find the trading result of the business. Now, as far as trading account is concerned, let's keep it very simple. As far as trading account is concerned, we record only two items. We record only two items. The first item is all information relating to goods. When I say all information about goods, we have learned in accounting basics, we don't prepare goods account. Rather, goods are known by opening stock of goods, closing stock of goods, purchases of goods, purchases returns of goods. So purchases and sale, these are the 6 names through which we identify goods account. And the second thing that is included in trading account is direct expenses on purchases of goods. So let's be very clear, in trading account, we focus on these two headings: information about goods and direct expenses on purchases of goods. Let's understand the list of items under both categories. So all information about goods. So as discussed just now, we have purchases, sales, purchase returns, sales returns, opening stock and closing stock. Whereas direct expenses on purchase of goods will include wages, freight inwards. Freight means transportation. When we are purchasing, goods are coming in. So transportation is coming in. So that's a direct expense on purchases. Then if in the problem it's given transportation expenses, that is also considered as a trading account item. Then customs duty. If you are purchasing goods from a foreign country, goods are coming into the geographical boundaries. Obviously, to the custom authorities, we are supposed to pay customs duty. So that is an expense on purchase of goods. Then we have royalty. Suppose I am the publisher. I purchase the right to publish a particular book. So the publisher is going to pay to the author what is called as royalty. and the publisher is going to purchase the rights. So similarly, royalty is also a direct expense on purchases. Then we have carriage inwards. So nothing but transportation inwards. When goods are purchased, goods are coming in. So also is the carriage, transportation. So carriage inwards. And finally, we have all manufacturing expenses. If there is no manufacturing account prepared, and suppose in the problem you are given with factory related expenses, manufacturing related expenses, then all such manufacturing expenses will be shown in trading account. If there is no manufacturing account to be prepared, all manufacturing and factory related expenses will be shown in trading account. Let's move further. Now, in trading account, we draw comparison between two items. One is cost of goods sold and another one is net sales. Now, what is cost of goods sold? This is not the first time that we are coming across this particular concept. We have come across this concept, if you remember, in adjusting entry. When I spoke about this concept of cost of goods sold, opening stock plus purchases minus closing stock. Remember this. So same thing, cost of goods sold is equal to opening stock plus net purchases. Net purchases would mean purchases minus purchase returns and minus closing stock. This is the original formula for cost of goods sold. But in trading account, we add one more point extra, that is plus direct expense on purchases. Then the next item that we have is net sales. So net sales is nothing but sales minus sales returns. Now, when we are drawing a comparison between these two items, understand, when we are drawing a comparison between these two items, we may find either sales, net sales greater than cost of goods sold. We may find net sales greater than cost. Sales is greater than cost. Revenue is greater than cost. So since revenue is greater than cost, it is called as profit. And in trading account, that profit is called as gross profit. So second result which is likely possible is cost of goods sold being greater than net sales. So cost is greater than revenue. Cost is greater than revenue. So the result is gross loss. Remember, in trading account, we identify that profit or loss with the word gross. Either we call it as gross profit or we call it as gross loss. So let's understand. In the trading account, we compare these two items, cost of goods sold and net sales. So cost of goods sold formula is opening stock plus net purchases minus closing stock. Sales is nothing but sales minus sales returns. Now, I am going to show these items, opening stock, purchases less returns, closing stock, sales less returns. Everything we are going to include it in trading account. And we will see how it looks like. So there is relevance of the sign. It's a plus. This is a minus. This is also a minus. Purchases minus purchase return. So there is a minus there as well. So either we get this number, net sales greater than cost, sales greater than cost, definitely profit. Cost greater than sales, definitely loss. And in trading account, that profit or loss is known as gross profit or gross loss. So let's move ahead and just find out how does a trading account look like. So when we record all these items, that is all information relating to goods and all direct expenses on purchases in trading account, we get a balance. And whatever is the balance in trading account, that balance will be transferred to the next final account part, and that is profit and loss account. So let's understand how does a trading account look like. Now a word of caution. I am showing to you on the screen trading account for the year ended 31st March 2000, some year, maybe 21, 22, whichever year you can take. Left hand side is called as the debit side. Right hand side is called as the credit side. Now one very important thing. Usually trading account is not prepared in isolation. You don't separate trading account from profit and loss account. But since we are learning about trading account exclusively, later on about profit and loss account exclusively. So once that is done, then combined, I will show you how a trading and profit and loss account looks like. Normally, there is no separate heading for profit and loss account. Usually we call it as trading and profit and loss account. But since we are learning it separately, I am showing trading account heading separately, profit and loss account separately. So when I combine that, I will show you how does the exact heading look like. So this is how trading account looks like. Now, if I go back to the formula, cost of goods sold, what was the formula? it was opening stock. So I record over here to opening stock plus net purchases. This is net purchases. That is purchases minus purchase returns. So purchases minus purchase returns will give you net purchases. So opening stock plus net purchases. Then we had a sign minus. So when I say minus, it will go to the credit side. So opening stock plus net purchases minus closing stock. So closing stock will be recorded on the credit side of trading account. So this is about the cost of goods sold. Then we had net sales, sales greater than sales less sales return. This is the net sales. This is net sales. Then we had also, this is information about goods, opening stock, purchases, purchase returns, sales, sales returns, and closing stock. So all information relating to goods are recorded in trading account. And along with that, one more set of information is direct expenses on purchases, royalty, import duty, customs duty, wages, freight inwards, carriage inwards, transportation expenses, all manufacturing or factory expenses in the absence of manufacturing account. All these will be debited to trading account. Remember this. So if I just make a slight tweak or slight change to the formula of cost of goods sold, it would be opening stock plus net purchases plus all direct expenses on purchases minus closing stock. So these are all plus. So shown on the debit side. And since closing stock is a minus, it is shown on the credit side. Then we have sales recorded as the first item on the credit side. This is gross sales less sales returns. This will give you net sales. Now, if I go back to the end result of trading account, either we have net sales greater than cost. So this value sales is greater than cost. That means credit side total is greater than the debit side. You will get the balance right here. This is the impact of sales greater than cost. Understand this. Sales is greater than cost. So when net sales is greater than cost, trading account will show credit balance. Credit side total is greater than the debit side. So you know debit balance, credit balance is first written on the debit side. And this, whatever is the balance as mentioned, will be transferred to profit and loss account. And net sales greater than cost, this will be treated as gross profit carried down. C/D is carried down because immediately after trading account, we start with profit and loss account. And this will be the balancing figure. Now, if this is not there, this in blue, gross profit is not there, debit side total is greater. That is cost of goods sold is greater than net sales. When cost of goods sold is greater than net sales, you will get debit balance. So debit balance is first written on the credit side above the total line. And whatever is the balance, whether to or by, you will transfer it to profit and loss account. And since cost is greater than sales, the result is gross loss carried down, balancing figure. So this is how trading account looks like. Now, very, very important aspect that we can pick from this. What is the journal entry for gross profit? The journal entry, say this is gross profit. The journal entry for gross profit is trading account debited to profit and loss account. This is the journal entry for gross profit. What is the journal entry for gross loss? The entry will be profit and loss account debited to trading account. So trading account is credited by profit and loss account. So this is how trading account looks like. Now let's understand the journal entry we just picked up. So journal entry for gross profit will be trading account debited to profit and loss account. And for gross loss, it will be profit and loss account debited to trading account. So this is about the concept of trading account and the gross profit and the gross loss. Let's move to the second aspect in final accounts, and that is profit and loss account. Objective of preparing trading account was to find the trading result, buying and selling of goods. Objective of preparing profit and loss account is to find the net result of the business, or we say the financial result of the business. And very, very important, understand, profit and loss account is prepared to find the current year financial result, current year profit or current year loss. So one word of caution. When we are talking about current year profit and current year losses, we are supposed to include current year expenses and losses, whether paid or payable. Current year incomes and gains, whether received or receivable only. All last year's items, all next year's items must be excluded. Only when you exclude the last year's and the next year's item, we can find exactly the current year financial result. Remember this. So current year incomes and gains, whether received or receivable, and are compared with the current year expenses and losses, whether paid or payable. And that will give us the current year profit or loss. So current year incomes and gains. Let's focus on the words. Current year incomes and gains are compared with the current year expenses and losses. Now, these incomes and gains, whether it is received or receivable, and these current year expenses, whether it is paid or payable, are also to be included because they relate to the current year. And the objective of including this is to find the current year profit or loss. Understand? Now, some important points to be noted. Profit and loss account belongs to the class nominal account. It is a nominal account. A nominal account rule is very clear. Debit all expenses and losses, credit all incomes and gains. So all expenses and losses will be debited to profit and loss account, and all incomes and gains will be credited to this account. So all expenses and losses, profit and loss account will be debited. All incomes and gains, profit and loss account will be credited. So let's analyze this. Profit and loss account debited for all expenses and losses. So that means all expenses and losses will be recorded on the debit side of profit and loss account. All incomes and gains will be recorded on the credit side of profit and loss account. Now, suppose if there is a credit balance. Credit balance means credit side total is greater than the debit side, meaning to say incomes and gains is more than expenses and losses. So if profit and loss account shows credit balance means credit all incomes and gains. Income and gain value is more than expenses and losses. So when incomes and gains is more than expenses and losses, that is called as net profit, because income and gain is more. So it is net profit. Similarly, debit all expenses and losses. Suppose if it shows debit balance, that would mean expenses and losses are more than incomes and gains. So expenses and losses are more than incomes and gains of the current year, then it represents net loss. So understand, if profit and loss account shows a credit balance, it represents net profit. If it shows debit balance, meaning to say expenses are more than income, so at that time it represents net loss. Now, how trading account balance was transferred to profit and loss account. Now, profit and loss account balance, whatever you get, whether you get a debit balance, that is net loss, or you get a credit balance, that is net profit, that will be transferred to capital account in the balance sheet. Understand this. So it will be transferred to capital account in the balance sheet. So let's look at profit and loss account in isolation. Understand, we had a journal entry for gross loss. The entry was profit and loss account debited to trading account. So profit and loss account is debited to trading account gross loss. Remember, this was found as gross loss carried down on the credit side of trading account. Similarly, you had entry for gross profit, and the entry was trading account debited to profit and loss account, and profit and loss account is credited by trading account, gross profit brought down. This was found on the debit side of trading account, which is now credited to profit and loss account. So as usual, all current year expenses and losses, profit and loss account belongs to nominal account. So we are going to debit all expenses and losses of the current year to the profit and loss account, whether paid or payable, whereas all incomes and gains of the current year will be credited to profit and loss account, whether it is received or receivable. And when we do so, if we get a credit balance, suppose if profit and loss account shows a credit balance, credit side total is greater than the debit side, then that balance, credit balance, is called as net profit. And that net profit, as usual given, will be transferred to capital account in the balance sheet. So it will be to capital account. So the journal entry for net profit will be profit and loss account debited to capital account. Suppose if profit and loss account shows a debit balance, that is expenses and losses is more than incomes and gains, you will get the balance right here. And that balance will also be transferred to capital account as by capital account. And this would be net loss, because expenses and losses is more than incomes and gain. That's why I get the balance here. So this is net loss, which will be transferred. Now we have seen trading account in isolation separately, profit and loss account separately. So before we go to the journal entry of a net profit and net loss, let's understand the combined format now. This is how the real heading of trading and profit and loss account will be written. We usually don't separate it. This is the common heading that is written. And at the end of trading account, profit and loss account begins. We don't write a separate heading there. And this is how trading and profit and loss account will look like. So we have opening stock, we have purchases, less purchase returns. This is net purchases, direct expense on purchases. Then we have buy sales, less sales returns. This is net sales, and buy closing stock. So if I get a credit balance in trading account, credit side total greater than the debit side, this is what we get the balance, and that is gross profit, and it will be carried down. Understand this: trading account debited to profit and loss account. This is now profit and loss account, which will be credited by trading account. So what was shown right here will be shown on the credit side of profit and loss account. Suppose if trading account was showing a debit balance, debit side total is greater than the credit side, you get the balance here. And you record over here by profit and loss account. So the entry is trading account is credited, profit and loss account will be debited. See, this is gross loss carried down, balancing figure. This is gross loss brought down. So whatever was the gross loss in trading account on the credit side will be brought down to the debit side below the total as gross loss brought down. Then now we are in profit and loss account. Profit and loss account belongs to nominal class of account. Debit all expenses and losses of the current year, whether paid or payable. Credit all incomes and gains of the current year, whether received or receivable. Then you are going to balance. So when we balance, we may either get a credit balance or a debit balance. If credit side total is greater than the debit side, you will get the balance right here, and that balance will be transferred to capital account. Remember, credit balance, credit side total, incomes and gains is more than expenses and losses. So this is net profit, and it will be transferred to balance sheet, and this is balancing figure. Similarly, if it shows a debit balance, debit side total is greater than the credit side, you will get the balance here. Whatever is the balance, that will be transferred to capital account, but this is net loss because expenses and losses will be more than if there is a debit balance, and this will be transferred to capital account. Now, what is the journal entry for gross profit? Journal entry for net profit. Entry for gross profit is trading account debited to profit and loss account. Entry for gross loss is profit and loss account debited to trading account. Entry for net profit is profit and loss account debited to capital account. And the entry for net loss will be capital account debited to profit and loss account. So we have it here, journal entry for net profit and net loss. The net profit, the entry is profit and loss account debited to capital account. So capital account is credited, means capital balance will increase with net profit. Here you see net loss, capital account is debited. Capital always shows credit balance. So when it is debited means net loss will be deducted. So capital account debited to profit and loss account. So this is about profit and loss account. Coming on to the last aspect of the final accounts of a trading business, and that is balance sheet. Remember, we said trading account, we said profit and loss account, but balance sheet is not an account. Balance sheet is a statement which is going to show the assets and liabilities of the business as on the last day of the year or last date of the accounting period. So balance sheet is a statement which sets out the assets and liabilities of the business as at a certain date. That certain date is usually last day of the accounting period. So that statement is called as a balance sheet. Now, when we are preparing a balance sheet, understand we are supposed to arrange the assets and liabilities inside a balance sheet. Under balance sheet, we will have headings. Under each of the headings, the items are to be recorded in order. So how are you going to arrange or place those assets and liabilities under various headings inside the balance sheet? That concept is called as marshalling of assets and liabilities. So there are certain guidelines. What are those guidelines? We will see that. It's coming in the next 1 or 2 slides. So the placement of assets and liabilities below the headings inside the balance sheet is according to certain guidelines, and that is called as marshalling of assets and liabilities. Now let's take, for example, if we take fixed assets. Under fixed assets, you will record goodwill, then you will record land, then you will record building, then you will record plant and machinery, then furniture and fixtures, then motor vehicle. Similarly, when you are recording share capital heading, in that share capital, we have authorized capital, issued capital, subscribed capital, called up capital, less calls in arrears, paid up capital. So likewise, there are headings under which you are going to show under a particular heading. There are a number of subheadings that you're going to show in order. So how are you going to record it under a heading one by one? As per the guideline, that is called as marshalling of assets and liabilities. Now, very, very important point. Forms of presentation of balance sheet. Let me tell you, there are two forms of presentation of balance sheet. One is called as the horizontal form and second one is called as the vertical form. Now I am going to present to you both horizontal form and vertical form of presentation of balance sheet. So this is how horizontal form looks like. Whatever you see in blue on the left of the screen, it is the balance sheet is prepared in a horizontal form. That is, liabilities and assets are written in a horizon. It is written side by side. It is written side by side. And this is the liabilities total. This is the assets total, which will be automatically equal. Because of the rule, for every debit, there is corresponding and equal credit. Remember the double entry principle. Now, if you look at this horizontal form, balance sheet as on 31st March. Usually we take 31st March, last day of the year. Liabilities are all recorded on the left-hand side of the balance sheet. And if you check over here, like an account, there is no to, there is no by. Remember, balance sheet is not an account. So no writing the words to and by. Writing the word to and by is applicable only in case of an account. Remember this, even in trading account and profit and loss account. Whereas liabilities are recorded. First, outsiders liabilities are recorded, then capital is written. So this is the opening capital. If there is any additional capital brought in, it will be added. Then if there is net profit, as we just saw in profit and loss account, that will also be added. Drawings, interest on drawings and net loss will be deducted. And this capital is called as closing capital. Then on the asset side, we record the liquid assets first. Liquid assets are those which can be converted into cash immediately. So cash is anyway in cash form. So cash balance, bank balance, outstanding income, prepaid expenses. Then we have closing stock, debtors, everything you can record. So this is not an exhaustive list. This is not an exhaustive list that I have shown. Then investments. Then we have fixed assets, land and building, plant and machinery, furniture, motor vehicle, intangible assets. So in this example, if you see, fixed assets are shown last. Similarly, over here, fixed liabilities called capital are shown last. Whereas liquid liabilities, or you can say current liabilities, liquid assets are shown first in the heading. So since the liabilities and assets are written side by side, it is called as horizontal form of preparation of balance sheet. Next, we have on the right-hand side in black, that is called as vertical form, where you write items one below the other, not side by side. So balance sheet as on the heading is same, particulars. We have something called as note number. I will tell you the relevance of note number. And usually we'll have one more amount column. That is the values of the earlier year, previous year's figures we say. These are the values of the current year that we have. I will talk about this. And this I have picked up specifically from the company's balance sheet, prepared under part 2 and 3 of Schedule 6 of the Companies Act of 2013. So we have these headings. The liabilities is recorded as equity and liabilities. So we have shareholders funds. In shareholders funds, we have underneath that item, share capital, reserves and surplus. So those are the items that we have. Then share application money pending allotment. That's another item. Non-current liabilities, and finally we record current liabilities. So remember, say fixed liabilities are first, share capital is first. Here we have recorded capital last on the liability side. Similarly, current liabilities are recorded at the end. Here if we check, current liabilities are recorded first. So just the reverse of that, because the next slide will speak about that. So current liabilities are written at the end in vertical form. Then we have assets under assets. Now this will be total. The liabilities will be totaled. So I have recorded in blue over here. Then we record assets. Under non-current assets, we have many subheadings, fixed assets. Then we have assets under development, capital work in progress, intangible assets. So that list are given under that. Then we have current assets. So current assets are recorded last. If you check over here, current assets are recorded first. So then this is total, assets is total. This number in blue and this number in blue will be equal. Like how we have side by side, these numbers are equal. So similarly, top bottom approach, this number and this number will also be equal. Now you may be wondering whether horizontal form is an outdated version and vertical is the newest version. Absolutely not. Remember, if you have businesses which are sole proprietary, partnership, such small businesses will prepare their balance sheet under horizontal form. Whereas if it's a company, say this is exactly company form. In company, we have company, then we have insurance companies, we have banking companies. But you will find slight change in the format of the banking company and the insurance company format. Remember this. Now, what is the relevance of this note number? So companies, banking companies, insurance companies have to compulsorily prepare their balance sheet under vertical form. Remember this. There is no option for them. They have to compulsorily prepare their balance sheet in vertical form. Now, interesting point over here is the note number. We also call this as, notes to accounts, we say. Suppose if I write over here shareholders funds and here I write note number 2. Say below shareholders funds, I write share capital, I write note number 2. And there will be just one number that will be recorded. And point to note, how you have arrived at this particular number that will be available in note number 2. All these vertical form will be accompanied with sufficient notes. And notes will explain as to how we have arrived at this particular number. Now, if you check over here, see we are adding, we are deducting. We are doing it inside the balance sheet itself, but in a vertical form, no adding and deducting within an item. Remember this. All those workings are to be shown in the notes, and notes actually gives you a clear post-mortem of every number in the financial statement. Remember this. So note number is, say I record 2, I record 3. So every note will explain as to how we have arrived at this particular number. Suppose there is, say, non-current liabilities, total value comes to, let's say, for example, it comes to around 2,45,000. How you have arrived at 2,45,000, that you can go to that note number, whichever number you have written over here, go to that, you will find you have arrived at 2,45,000, which is recorded over here. So horizontal is side by side, vertical is top bottom. So liabilities and equities written first. And remember, this is followed by companies, whereas this is followed by any businesses other than companies. So it's not that horizontal form is outdated and vertical is the newest one. There are no points relating to that. And finally, we come across approaches in presentation of balance sheet. So we have two approaches. One is called as liquidity approach. And under liquidity approach of presentation of balance sheet, most liquid asset is written first, less liquid asset is written next, and fixed asset is written last. Now, if I go back to this particular format, most liquid assets is written first, less liquid assets is written next, and fixed assets are written last. So this horizontal form balance sheet that you see over here is actually prepared under liquidity approach. And under liquidity approach, you will always find cash and bank written as the first item on the asset side of balance sheet. Similarly, over here, if you don't have a bank overdraft, you will have creditors recorded over here. And your fixed assets will be recorded last, fixed liability capital will be recorded last. So this horizontal form that you see is exactly the liquidity approach that we have. Most liquid asset, less liquid asset, and fixed asset. The second approach that we have is the permanence approach. Fixed assets are recorded first, less liquid assets are recorded next, and more liquid assets are recorded last. This is also followed. We have seen this also if we check the vertical form. In vertical form, we have recorded fixed assets. Non-current assets means fixed assets. Then we are talking about, less liquid assets. And finally, we record cash and bank balance. The most liquid assets is in current assets, cash and bank balance will be recorded last. Remember this. So the vertical form that you see is based on the permanence approach. You can record shareholders funds, share capital. That is the most permanent liability, you can say, fixed liability that we have, permanent liability, that is recorded first. And current liabilities are recorded last. So horizontal form is prepared under liquidity approach, whereas vertical form is prepared under permanence approach. That means permanent asset and liability first, fixed assets first, share capital first, So those are recorded first. So these are the two approaches that we have, liquidity approach and permanence approach. Usually for all small businesses, we follow liquidity approach. And for all big businesses, especially companies, where we follow vertical form of balance sheet, we follow the permanence approach. So that's all we have in this particular session. In the last session, that is session part 16, we will be solving problems on final accounts. So for this particular point of time, thank you very much for your company. So once again, if you have any topic, that you have certain issue with, feel free to send a comment in the below the video, and I'll be more than happy to prepare it for you. So if you'd like to connect otherwise, here's my email ID and my number. So thank you once again for your company. Thank you.